Warm welcome. Good evening, everybody. I hope you guys are having a lovely Saturday evening. I hope you guys can hear me loud and clear. You can give me some comments below, just to double check that you guys can hear me loud and clear before we begin the session. Just give me a second. Let me load up. Let me load this up. So, of course, we are streaming to you live, both on Facebook and also on YouTube. Okay, so I see some of you guys are on. If you can hear me loud and clear, just say okay. That'll be great. Okay, I'll clear YouTube. Fantastic. Thank you very much. Welcome. Very warm. Good evening. Now, I made a mistake last segment. I thought it was the last episode. Brought to you by Bursa Malaysia. But today's segment is brought to you by Bursa Malaysia. Today is an educational segment. So we've been running this. I think we've run a total of almost 20 episodes, both English and Mandarin. And last night, if you guys tuned in, you would have heard Benny running the segment in Bursa Malaysia, right? Kudos to him. I never knew he could speak PM so well. So I hope you guys are ready to learn for the next hour and a bit, 1.5 hours. Now today's segment is all about use of financial ratios for investing. And if you like me, when I kind of first started trying to pick up books, I picked up many books, because I thought financial ratios were really the key to investing. So it's kind of today I want to debunk some myths about financial ratios. I will also talk about the financial ratios that I do use. In fact, they are quite simple. I will also give you the very basics that you will need into actually understanding financial ratios, right? So today's segment is all about financial ratios. So I hope to keep this as interesting as possible and not put you to sleep, because this is quite a heavy subject when it comes to numbers, right? So let me just sort of share my screen here. Now, of course, like every segment, if you guys have any questions regarding any of the slides, of course, these slides are made available to you. Do stay to the end, where I kind of wrap it all up. And as usual, some of these segments that I do, I always try to include something that is current, sort of for discussion purposes, right? So let's get started. So before we proceed, this webinar or this live stream is actually brought to you by Bursa Malaysia. A big disclaimer: we will not be doing any stock picking. This is not financial advice. This is purely for educational purposes only, right? And if you need financial advice, please speak to your licensed financial advisor. This is purely educational, right? Okay, so if you guys again have any questions, post it below. This segment is brought to you by Bursa Malaysia. You can access some of the tools that they have provided absolutely free for investors like you under Bursa Marketplace. Of course, these webinar segments that we run will also be uploaded on Bursa Academy at Bursa Marketplace, right? So go check it out. Okay, well, my name is Alvin. I will be your live session trainer for the next hour and a half. I think some of you guys already know me, so I think I'll just proceed. Okay, let's continue. So thank you, some of you guys who have given your comments. Colin, thank you for your comment about my hair. You realize this segment and last segment, it was quite different. I recently shaved my locks for charity because we hit above 200,000. So thank you all of you guys for being so generous. So here I am sporting a not so much hair. Okay, now so let's begin. I think I always like to begin with these slides because it sort of sets the tone for what we're going to be talking about, right? When we start investing, we have to understand that two main segments that you can actually go with, like two paths you could choose, right? Like the blue pill or the red pill, right? Now you can actually successfully make quite a bit of money if you speculate, right? Speculate meaning that you are speculating when you buy a stock or a warrant or any instrument, and you can speculate on any kind of financial instrument, right? But if you are speculating, understand that it's a very different mindset from investing, right? So investing is essentially investing in a business, right? It is generally long term in nature, right? Speculation can be a day, could be hours, could be generally much shorter term, right? And the mindset between your investment and your speculation is very, very different, right? Now, why I want to put this out is not so much about what's the theory behind it, but very much as you as the investor, do you know whether you're speculating or investing? Because the most dangerous thing that you can actually do is that you don't know whether you're speculating or investing, right? So you go into stocks thinking, yeah, you just want to make a quick buck. And then when the price comes down, you say, no, then I now use investing principles, right? So you have to choose the path quite from day one, right? When you start investing or when you start speculating, whichever it is, you must know which path you're on. Because if we're going investing, we're thinking longer term, we're actually looking at business metrics, we will look at financial statements, right? Those are the things that we'll proceed with, right? So this whole segment we're going to talk about is really how to use some of these financial ratios if you are investing, right? And no better person to start off with to talk about investment is actually Mr. Benjamin Graham, right? He's actually known as the father or grandfather of value investing, right? And if you look at him, he actually wrote two books. One's called Security Analysis, and the other one is called The Intelligent Investor. And if you really look at, if you're not sure who Benjamin Graham is, Google him. He's very, very popular amongst investors. He first published his book in 1934, right? He was actually a professor at Columbia University. And back then there was, so if you guys have a CFA or you're in finance or you have a finance degree, back then 1934, finance as a degree didn't actually exists, right? It only started in the 70s in the US, right? So because it's very statistical in nature, he started what investing is, and he said that he gave one very well defined definition of what investing is. And you can break it down into three segments. He says that you must do thorough analysis, there must be safety of principle, and there must be adequate return, right? Only if you meet all this, it is investing. Operations not meeting this, if you can see here, he's saying that these are speculative in nature, right? So he also sets it very clearly, what is investing and what is speculation. Of course, today, this department in Columbia University still exists, right? They still talk about value investing. They talk about really what investing is all about. Now, I'm going to take a couple of excerpts because we will be running financial ratios, right? I think those of you who actually have been investing for a while and you've tried to kind of find a secret formula, I think naturally one of the things that we get drawn to, especially I see a lot of the students that come through to my classes, right? I see they build some really, really cool, what I call spreadsheets, right? Almost dashboards. They put all sorts of macros in there, and if you kind of step back, you kind of say, let's not miss the forest for the trees. Is that if you keep going deeper and deeper into financial ratios, my personal view is I don't think you're going to be successful just by doing that, right? Financial ratios, if anything, are tools that you use to actually come to decision making, right? But it is not the be it and all of it, right? That's not what investing is, right? Neither is investing a formula where we find what the intrinsic value of a company is and we buy and then subsequently you'll make money. Unfortunately, that also does not happen, right? In my personal view. So you kind of have to look at investment from very kind of pragmatic view. Why? You have to think about all this, right? Ratios and numbers and formulas are absent of human behavior, right? Which means that, and if you think about a business by itself, right, its customers are humans, the CEO, the management are humans, the shareholders are also humans, right? So there's a lot of human behavior factored into businesses, right? And what Benjamin Graham said, I think he hit it right on the nail. He said that investing is most successful when it's most business-like. So you have to look at investments from a point of a business, right? If you run your own business, I think you're already at an advantage of understanding and valuing businesses, right? If you run your own business, big or small, it doesn't matter, because big or small, the headaches just compound, but the problems are more or less the same regardless of what industry you are in as well. Yeah. So if you look at if you guys kind of look at this, you have to really very much approach this from a business standpoint. When you're investing in a business, you must look at it from a business standpoint. And why I want to kind of open with this is very simple, because when I first started and looked at financial ratios, I'm going to show you some of the common financial ratios that have been put out there, and I'm kind of going to debunk a lot of them, right? In fact, most of them. Why? Because I believe a lot of these potentially were invented either by accountants or some of these ratios, right? And I don't think they are very business-like. So where I'm going to kind of change things a little bit is actually look at ratios from a business point of view to give you an idea how they actually work, right? And in essence, so this is the second one from Benjamin Graham. He says, ultimately, why are we doing all these financial ratios? Why do we do all this homework? Well, what is the real purpose, right? The real purpose ultimately is the management of your risk, right? When you want to look at all these numbers, I'm going to tell you one thing. No one number is going to tell you whether it's good or not, right? So if you can get a financial ratio, for example, PE of 10, it won't tell you whether it's cheap or expensive, unfortunately, right? It's probably one piece of a whole puzzle, right? One part of a whole picture that you actually need to put into the jigsaw to actually see the whole picture. So I'm going to give you guys some nuances around what I mean by using financial ratios and really how do you actually use some of them. Ultimately, he says investment management is the management of risk, not the management of returns. He said if you manage your risk, your returns will ultimately come, right? And I believe this is largely true. Okay, so now let's proceed. Right now, let's look at some very basic ratios. Right now, even if I'm not talking about financial ratios, right? Even if you use them in science or you talk about bacterial culture or anything else, ideally, most of the time, purely looking at one number won't tell you if it's a good or bad thing, right? So for a couple of things that you need to look at when you look at ratios. Number one, you can never use ratios, one single ratio, to determine whether it's good or bad. Typically, what will help you is actually to create a timeline of ratios, which means that either you compare over years, you compare over quarters, or you compare against its peers, right? Because really what you're trying to do is find a balance as to, if this number is showing me this, what does the whole kind of picture look like before I can determine is good or bad, right? I mean, I give you an example, right? If I say this person is 60 centimeters tall, is he tall or short, right? You can't tell, right? So you say, yeah, this guy's 160 is shorter than, if I compare to NBA players, right, who are, let's say above 2 meters, 200 cm tall, right? I would say 160 is short, right? But if I was comparing myself to generally much shorter people at, say, 130 or 140 cm, then you say, yeah, 160 is tall in comparison, right? So really, ratios by themselves actually cannot be used for standalone decision making, and that's really the idea behind it. And kind of at the end, if you stay till the end, there's my last slide. Actually, I'll show you how I've kind of put it all together, and I kind of did one for banks today because I thought it was quite topical in nature. to sort of put them all together to give you a clue, right, as to how you would rank them, right, using financial ratios. So financial ratios can also be split into two very distinct segments. Okay, if you've seen some of my previous episodes before, I said, look, in investing there are two risks that you have to look after. One is timing, the other one is capital, right? Capital pretty much talks about a business. Is the business high risk, low risk, right? Timing risk, ultimately, are you buying the company at very expensive prices, or you're buying at very low prices? So ideally you want low capital risk and low timing risk, right? Ideally. But not to say that's the only way to do it, right? You could have low capital risk and still have medium to high timing risk if the company grows, right? So you can still make money that way, right? Ultimately, what I'm showing you to sort of preface this whole segment I'm talking about is this, right? So if your capital at risk is high, for example, I don't think there is a low timing risk, right? From an investing viewpoint, right? If you're investing and a company is very, very risky, right? There's no point timing it, because eventually, if it's very high risk, a very high chance that it might go under, right? So there's no point timing it as well. So that's from an investing viewpoint why we look at these two main segments, yeah, capital and timing risk. So a lot of stuff that I'm going to show you here today are going to be very good for everything except for financial companies, right? For financial companies, I'm going to kind of touch on it at the end, where I actually have one slide to kind of summarize it all. So a lot of these numbers that I'm going to talk about are either trading companies. So financial ratios, you can't use the same financial ratios for finance companies as well. Here's the thing, right? So there's no one size fits all kind of comparison that you're actually going to get. It's actually going to be a combination of numbers. So I want to show you some of the things that you can use, some of the things that you may or may not be able to use, right? Especially when we talk about the working capital portion. All right. Look, I mean, while we sort of go on, if I get some sort of comments from you guys who are watching in tonight, what kind of financial ratios, or what is your favorite financial ratio? If you can just put in the comment section below, or right, have you got a financial ratio that you're curious how to actually use, right? So post it in the comment below. If you can tell me what is your favorite, or some of your favorite financial ratios, right? Or some of the ratios that you think that that you don't understand and you're kind of trying to figure out, right? So today I'm actually going to be sharing financial ratios that I use most of the time. And I don't use financial ratios exclusively to make investment decisions. I think that's going to be quite a difficult thing, but they actually kind of help you paint a better picture, right? That's it. And we have to understand this, right? Financial ratios are past history, right? It is based on, a lot of it is based on your financial statements, and financial statements have already been has already happened, right? So they're not so much forward looking in nature. They're actually very much historically looking, right? But the whole idea here is to give you a sense, right, of what your capital at risk is when you look at some of these financial numbers, right? So we get some comments below for you guys. What is your favorite financial ratios? I know everyone has their favorite financial ratios, right? Or some of the ratios that you may have heard of, but you're not quite sure how it works, right? Now here's the very funny thing, right? You have to understand this. When it comes to financial ratios, that is not always a definition that is global always all the time, right? Except for a few, maybe like your PE and your DY, those are globally accepted, or maybe ROE, right? But there are tons of financial statements. Someone was asking me, hey, what is debt ratio, or ask me, can you have a negative leverage ratio, right? I always ask, what is that formula to get there, right? Because everyone kind of tweaks their own formula in their own way, and there's so many ways you can tweak those formulas, right? Even having the same concept, right? So what ratios can be used for timing risk, right? Business PE, KPE, right? Okay, current ratio, quick ratio, debt to equity. Okay. Look, these are some good ones. I hear them all before, and I'm just curious. Do you guys actually use them for financial making? And that's probably an interesting one, right? So those of you who are tuning onto YouTube, I'd like to see some comments from you guys as well. What kind of financial ratios do you guys use? Or most of the time, or what's your favorite one, or which are the ones that you actually want you want some clarity on. Okay, so now I'm going to put financial ratios into 4 main segments. Okay, one has got to do with liquidity. What do I mean by liquidity? Okay, liquidity is how quickly a company let me put it in very simple words. How quickly a company can turn its assets, right, into cash, or how liquid are they in terms of cash, right? Liquidity has got to do with, if you think of liquidity, think of it like your engine oil, running your engine, right? How liquid is your business so that it can continue running, right? So liquidity is almost like the lubricant in your engine to keep it running. Okay. The second one is called gearing, right? So gearing, I see some comments below that debt service ratio, or debt ratio, leverage, and so on. So gearing is just a fancy word to tell you how much debt you are in. That's it, right? It's just a fancy word, right? I know Americans use a slightly different term. They use leverage, right? Or gearing. It's a very British term. Either way, it means the same thing. Okay. The third sort of segment that you can box them in is actually profitability, right? So each of them is to measure different things, right? Just for example, if you go for a blood test, if you go for, let's say, a glucose test, it shows you how much, I'm not a medical doctor, but glucose levels will tell you I guess how I guess when you do a blood test for your glucose level, you drink that bottle quickly to see how fast insulin actually produces to check whether you're diabetic or not, right? But that's all it does. It doesn't do anything else, right? If let's say you are doing a blood test for, say, let me see, what's I don't know, can you do one for, well, I can't think of one, but I'm not a doctor, but I just want to give you an idea that each test that you do is for different purposes, right? That's the exact same thing I'm trying to tell you here. Each test that you do for each of them, these 4 segments, is actually to just give you the purpose for that, and that's it. They won't tell you anything else, right? So gearing will not tell you whether the company is profitable or not, for example, right? How liquid you are will also not tell you how much debt you are in. Okay. How profitable you are will not tell you whether the company is cheap or expensive, for example. All right. So these are just to give you an idea. So these are really essentially how you're going to break them down into the 4, right? Now, before we go there, I get asked this quite a bit, and I think for those of you who are invested in Bursa Malaysia, I just want to just sort of preface this, because you guys need to know how to actually know the timing first. Okay, why do I say this? Because when you look at financial ratios, a lot of people ask me, what's the PE of this company? So my reverse question is, what PE are you talking about first? There are many different types of PE ratios, right? Are you talking about the audited PE? Are you talking about the trailing 12 months PE? Which one are you talking about, right? And really, when you talk about financial ratios, it's what number you plug into those ratios, right? So before you do that, you kind of have to get a feel of how it works, right? So what I've done here is give you an idea, right? If you look on the left of your screen, you're going to see 1st Jan, and you're going to see the end of the screen is going to be 30th June. So if you can imagine this, 31st December is somewhere here, right in the middle here, right sort of middle or 2/3 of the way here. Now, one thing we have to familiarize ourselves with is this first, right? Every company will have what we call quarters. Okay, now, so I'm going to make that assumption here that the company that you're looking at, the financial ratios, the financial year end is 31st December, which is right here. Okay, assuming it is, right? So which means first quarter runs from January 1st to 31st March. Second quarter runs from 1st April to 30th June. third quarter runs from 1st of July to 30th September, and fourth quarter runs from 1st October to 31st December, right? Now, these are when the quarterlies are measured, okay? Measured first, that's not when it's determined, right? They are actually reported now on Bursa Malaysia. Most companies, and except due to COVID-19, where they actually did an extension because of the MCO, people couldn't go back to the offices, they couldn't sign off audited accounts, right? Except for 2020 when COVID happened, this is actually standard amongst all, right? So what happens is this: quarterly results generally you're given 60 days from your quarterly from when your quarter is supposed to come out. Okay, so for example, if your quarter ends on 31st March, they give you 60 days to make the announcement, right? If it's 30th June, actually the announcement date. So I've put 60 days, so I've put the end of quarter plus 60 days to give you a guide. Of course, some companies choose to release it earlier in 40 days, they release it in 30 days, that's fine as well, right? Now, and that's why if you look at where we are this month is August, you're going to see a lot of quarterlies are coming out now. If you can see, a lot of the quarterlies are coming out because a lot of them are your Q2, your calendar Q2 results are now coming out, right? Now, so what is important to you as an investor? The announcement dates are important because that's when you know how well the company is doing. But you must also, for analysis, you must also take note of when their actual quarter is actually going to be when they release that quarter, which quarter are they going to talking about, right? So in this case, so for example, we had the MCO from 18th of March till the first week of May or second week of May. You're going to see that a lot of businesses in the second quarter calendar year are going to be seriously affected, right? So which means that a lot of the numbers that's going to come out this quarter, for those who are really badly affected, I'll be surprised if anyone is reporting fantastic earnings, right? You're not going to be shocked anyway, right? So what you're going to kind of see is actually whether they have recovered in the third quarter, which is where we are right now. But you only know that in November, right? And of course, what you're going to see now is that I think most of you are aware of the bank moratorium, right? So for a lot of loans, I think everyone's kind of jittery. Will the bank survive, right? Now, in terms of some of the banks, in terms of moratorium or the write-offs that we're going to see, because the moratorium is only going to end in October, right? If I believe, right? So April, May, June, July, August, September, October, right? So they're actually going to be well into their fourth quarter results. So you're actually going to really start seeing some numbers for banks, how affected they are, actually only in February, right? So that's still some months away. Okay, now, so this is really just to give you an idea how you would kind of look at them, right? Because when you're using your P ratio, your dividend yield, or your operating cash flow yield, or whichever yield that you're using, right, or your debt to equity ratio, any of these ratios, you must kind of see which quarter are you referring to. Okay. Unless there is some major change like COVID-19, you will use the quarterlies, right? Otherwise, most of the time I use the annual with the quarterlies as well. Okay. Now we have to understand one thing about the quarterlies, right? The quarterlies are not audited, right? However, if there's a rule on Bursa where if it's more than 5% deviation from the unaudited to audited, actually all the directors get fined as well, right? So most of the time the quarterlies are very close to your audited numbers as well. So you can rely on them. Okay. Now, what happens after the quarterly is done? So after 31st December, actually you're given 120 days to actually announce your audited financial numbers, right? And then subsequently, you're actually getting 180 days in total after your financial year end to actually report your annual report as well, right? So these are kind of the rules of the game that I think all investors need to be familiar with, because that should come second nature to you, because these are just general rules that you need to know. Now, just to give you guys a flavor of where we're at, right? So when you talk about reporting season, why is reporting season so important, right? So this was something I plugged out last year in April. Out of 924 companies this on Bursa Malaysia, actually almost 70%, right? So 16% of companies actually have 30th June as their financial year end, and almost half of the companies have 31st December. So you kind of add these, because whether you're 30th June or 31st December, it doesn't matter. This whole thing still applies. It's just what quarter you're in only, right? So this whole announcement date all applies, which means that 70% of quarterly numbers generally will come out within this stipulated period that I put in, right? Basically, you're going to be looking at August month, May month, November month, and February month, right? Those are the peak periods where quarterlies actually are all announced, right? So what I'm going to do is just give you guys an idea, and I'd like to do some interaction with some of you guys who have tuned in on a Saturday. I know it is a holiday. It's kind of a long weekend for us here. So for you to really tune in, I really hope you guys get the most out from this. And for you to get the most out from this really is to kind of get you guys to engage with me as well, and put it in the comment section below, right? Now, so just to give you an idea, for a company which is financial year end 30th June, right? What are the end dates for each quarter? If you look at this, and what is the day of announcement for these, right? So I'm going to show you the answer for the first one. So it's the same, right? So their first quarter is 30th September, second quarter is 31st December. I know it's very weird, but this is generally how it works. Your third quarter is 31st March, and the fourth quarter is 30th June, right? For those companies, financial year ending 30th June. These are the most common ones, 30th June and 31st December. We do have some weird ones where it's February, it's March, some are in September. You can pick any month, right? So it doesn't really matter. And these are audited accounts are 120 days, right? And the annual report is also here as well. So I think I made a mistake. Your fourth quarter should be 30th June, right? Annual audited account, oh, sorry, it's here. Yeah, all 30th June, and this is October and December here. So just, since it's going to be Merdeka, where we celebrate our National Day in a couple of weeks' time, right? So there are companies where their financial year end is 31st August, right? There are, right? I believe Top Glove is one of them. Very patriotic, that their financial year end is 31st December. I believe the Naga was as well until they changed it. But if your financial end was 31st August, right? When would your first quarter end, right? When is the first quarter ending, right? So you can kind of put in the comment section below, just to get your mind thinking, right? And to see that you guys actually have absorbed a little bit of this before we head on to financial statements. So are you guys able to answer, right? Okay, so Colin is asking, why doesn't Bursa make all companies have the same financial year? It's quite confusing. I think ASX companies all have the same. Actually, I don't believe all it's not something mandated by Bursa. The Bursa is actually a stock exchange, right? In fact, in Malaysia, it's a CCM, right? Your Commission Companies of Malaysia. That's where you register your company, right? So, so it's not something that is mandated by the stock exchange itself. And really, most companies are free to choose when it is. I know it is confusing. It is, especially for first-time investors. It is confusing, right? But that's the world of investment, right? So, and that's why I guess we need some education to go along with this. Now, so you guys put November 30th, end of first quarter. Let me see. Yeah. Okay. So you guys got it right. So if you can kind of answer this, November 30th, right? You guys got it right. So look, really that's the whole idea behind kind of financial numbers, right? We have to know the timing first. You know the timing, then definitely, right? Very easy to move forward. Okay. So I hope you guys kind of, it's great that you guys are actually listening. So I thought some of you guys would just kind of switch it on and leave it running in the background. Okay. Okay. So now let's move on. Okay. So one thing that you have to kind of really remember is this, right? Whenever you look at, so what I have an example here is what is known as trailing 12 months or I like to call it, or we like to call it, rolling 4 quarters at Equitiestracker, right? So what does rolling and trailing 12 months actually mean, right? It means, right, from at any point in time today. So for example, here today, whatever has been released is only been Q1, Q1, Q4, Q3, Q2. So which means Q1 has only been released, but that's Q1 for this year where we are today. Q2 has not been released yet. So for us to make a judgment, right, to calculate some sort of ratios, right, we want the latest numbers. So what we'll then have to do is take whatever is released, let's say Q1, I use Q4 last year as an example, I use Q3 as an example, and I use Q2, right? So I add 2, 3, 4, and 1. That means 3 quarters from last year, 1 quarter from this year, to sort of give me an estimate on what kind of revenues I'm making so far. Right. So in this case, I've actually pulled out Nestle Malaysia. This is what their quarterly numbers look like. But that's essentially what a trailing 12 months or rolling 4 quarter actually does, right? And you actually can use this for your PE ratios, for example, which is a timing indicator, right? I think someone asked earlier, what is timing ratios, right? So I'll cover some of them, but the most common one is PE ratio. So when you say PE ratio, you have to be very careful where you take that P ratio from. Or whenever you read that P ratio, what is it representing? Is it price today over last year's earnings? Or is it price today over its latest 4 quarters added up together? You're going to get totally different numbers. Okay, I just want to highlight to you, right? Something as simple as a P ratio will give you something conflicting that way. Okay, and that's why, you know, one of the things I mentioned very early on in the beginning of this segment was, if you are talking about financial ratios, you must know what is the formula, right? What are the numbers that they're using? Otherwise, it's going to throw you way off. Okay, so just to give you an idea what trailing 12 month is as well. Okay, now so let's kind of get into liquidity ratios, right? Now the most common one, I see some of you guys that have actually commented, thank you very much, like PE, we've got NTA, we have debt to equity ratio. I see some of you guys have talked about current ratio, you've talked about quick ratio, again debt to equity ratio. We've got some free cash flow, business PE, we've got ROE. Look, here's where I kind of want to differentiate this webinar from most, right? If you go online today and search financial ratios, and that's what I picked out, right? These are the common ones you're gonna actually find: current ratio, acid test ratio, quick ratio. Okay, in fact, these are quite well defined. You can Google it, and it's literally free. You can go to Investopedia. They actually give you all those numbers, right? But that's not what I'm trying to actually do, right? If you look at, I just give you guys a very simple example. For example, current ratio. Current ratio is basically your current assets, right? Which means your cash, your receivables, your any current assets that you have, divided by your current liabilities. Okay, now current, I mean that it can be turned into cash with less than 12 months, right? So very close to cash, right? I don't necessarily agree with this ratio. All right, they always say that any current ratio more than 1 means it's good, right? I'm going to tell you that the opposite is actually true, right? And I'll explain it to you why, right? So a lot of these ratios that we're using today, I want to give you guys my set of ratios that I use, right? And the basis for all this is the reason exactly what Benjamin Graham is saying, right? Investing is more successful when it's most business-like. Okay, I can almost tell you that if you're a business owner, you're not going to be using return current ratio to actually determine how liquid your business is. Okay, so let's kind of play around with these sound numbers. Okay, the next segment, profitability ratios, you would have definitely heard of return on equity. You would have definitely heard of return on assets or return on total assets, known as ROA or ROE, right? You will definitely have heard of gross margin. You have definitely heard of net margin as well. Okay, I don't personally use return on equity because it's very much an accounting number, right? The question is, what is equity mean, right? To the general person, right? What does equity mean? I mean, if you run your own business today, what is your equity? It's unlikely you're going to run your business looking at measuring your equity, right? So your equity is basically your assets minus your liabilities. Whatever's left over is known as equity. And this equity can be demonstrated in multiple forms of ways, not just in cash. It could be multiple assets, right? It could be previous profits that be replowed back in, right? It doesn't make if you're a business owner, it's unlikely you're going to measure your business based purely on ROE, right? So then, as investors, why are we doing it, right? In fact, if you look at return on equity and return on assets, they are kind of what I will classify them as efficiency ratios. It kind of tests you how efficient your company is, or how efficient you are sweating your assets, for example, right? Gross margin and margins, I like them, like to complement with other things as well. I think that's quite good for profitability. Gearing ratio, debt to equity, I think everyone has kind of heard of it. If I'm not running my business purely looking at my equity, then why does debt to equity actually matter? If you're not a financial company, you're not lending out money, let's say you're in manufacturing, debt to equity almost has little or no meaning to an owner, right? Now, what I'm trying to say is that these are all very textbook examples. What I'm trying to approach financial ratios is actually from a business standpoint. I think that's going to give you a lot more mileage for this as well, right? Of course, timing ratios, I think someone asked earlier, I think we had someone from the crowd who asked about timing ratios, right? What are timing ratios, right? So just to give you an idea, PE is a timing ratio, dividend yield is a timing ratio, price to book ratio is a timing ratio. Now, how do you know the ratio that you're using is a timing ratio? Very simple. It uses the latest price. Okay, that's it. You have to use the price to determine the ratio. Then you know it's a timing ratio. Okay, if it uses nothing to do with price, then it's not a timing ratio. Okay, so for example, a gearing ratio, debt to equity, doesn't use price. Return on equity, return on assets, gross margin and margin, none of them use price. Current ratio, asset test ratio does not use price as well. Okay, so as long as you're using price, it is already a timing ratio. Okay, and I kind of put all this together later when you guys can actually have a look at it. And I've used banks as an example. Now, so ideally, the whole thing is this, right? Look, no one's gonna get rich just picking up a book about the theory. The whole idea here is about how do you actually actively use this and practice it, right? And the idea behind this is actually to look at it when it's most business-like. So we're gonna jump into literally the practical side of things now. Now, my top liquidity ratio numbers that I use, okay, is actually these two, right? Payable receivables and revenue versus receivables. Okay, these are my liquidity ratios. That's what I use, right? I want to know how liquid the business is to continue sustaining itself, right? Of course, operating cash flow is also another one of them, but I just want to show you guys from a ratio perspective, what do I mean by this? Okay, so here I've actually plucked out Nestle's numbers. I know it may look a little bit small, but I just wanted to show you where you're going to get it from. So this is actually essentially from a balance sheet, right? So what I have here under your current assets is your receivable numbers, and under your current liabilities, these are your payables here, right? So how you read this will be from the right to left, right? Which means 2010 is here all the way to 2019 here. Okay, now if you look at this table here, I actually have another one where it's kind of zoomed in and you can see a little bit better. You're gonna see that the receivables now is essentially what are receivables. Receivables is what your customers owe you. Okay, very simple. And what are payables? Payables are what you owe your suppliers. Okay, so I'll repeat. Receivables is what your customers owe you. And that's why it's an asset, because people owe you, right? Payables is what other people, what you owe your suppliers, what you owe other people, right? Now, if you look at this, if I have used a current ratio on Nestle, it would have failed through and through, right? Because its total assets, if you look at its total assets, 700 million, 1 billion, 800, 900, of its later years, 1 billion, and its total current liabilities is 1.6 billion. So current ratio is total current asset divided by total liability. They say more than one is good. In fact, I'm going to show you the opposites, right? We all know Nestle is a great company. It's properly well managed. If you look at the share price, it's done really, really well. It's not a new company. It's very old. It's more than 100 years in Malaysia already, right? Nestle. So how can they survive having current ratio? If you use the common analogy to say that, look, current ratio needs to be more than one means good. In fact, here's where the flip side is, right? What I have here, I've actually plugged these numbers out so you guys can see it a little bit more clearer. And you can actually see from 210 all the way here, 210 all the way here. Now, here is the beauty of what they have done here, right? If you look at this, their revenue has actually grown over time, right? So if you look at them, the revenue has grown over time. But what you're going to see here is actually receivables has also grown over time. That means what their customers owe them. And this is normal. Now, when you see a very distinct method from Nestle here, and this is where it kind of gives you the clues, right? Its payables continuously grow, and in fact, they outpace their receivables. Now, what does this mean? It means that less people owe them for the size, right? And they owe more people more money, right? So if I put it in a business perspective, which means that I can now collect faster from my customers, but my suppliers are willing to give me even longer credit terms. Is that a bad thing? Or is that essentially showing you the strength of the business, right? If you use common financial ratios, it will fail. But when you think of it from a business standpoint, and that's essentially what it is, it means that I can collect much faster from my customers, and I can pay my suppliers much later. That's essentially what it is, right? So if you look at their ratio here, receivables over payables, the number keeps dropping. So, if I cut this off from the graph, you're going to see the number keeps dropping, right? Which means that they're collecting faster and faster, and their suppliers are giving them even longer credit terms, right? Now, why? Now, if you think from a supplier point of view, of course, you're not going to be happy, right? But you're going to say, look, I have now the ability to supply this very, very big company. And yes, they will definitely, they order in big volumes and they want very, very good credit terms, right? And essentially, so if you look at this, right, they've done fantastically well. And this was done on purpose, right, to actually improve their working capital. So like someone just mentioned, called Wei Ming, right, it shows good working capital management. Absolutely. Now, imagine if I used the normal definition of a current ratio, what is good, what is bad, you're going to see why it's so wrong, right? So you have to kind of look at it from a business angle to say, look, if I can receive my money as quickly as possible and my suppliers are willing to give me longer credit terms, it essentially means that I'm big enough, or my company is big enough that I can wield that kind of influence to get those kind of terms, right? So those are the kind of clues that these numbers should give you, that this is, without even looking at the business itself, and looking at over time, and of course you look at other numbers, you're going to say that there's something unique here. Why are suppliers willing to supply them and give them such long credit terms, longer and longer every year, right? So these are the numbers that kind of infer you to come to that conclusion, right? And that's why we cannot, I know I get a lot of these questions. Is this number high means good, or this number low means good, right? I don't think you can approach financial ratios from there. You have to understand exactly how the ratios are derived and what they actually mean. Now, so what I've done here is actually spread it out over 10 years to give you an idea, right? And that's why I say if you look at financial ratios, you must spread it out over a period of time. So I hope this is one example for you guys. Now, the other number that I look at for liquidity is receivable days. How quickly, if they grow their sales, how quickly are they collecting their money from their customers? Now, in this case here, their revenue over the 10 years have grown from 4 billion to 5.5 billion. This is a big amount, right? Of course, its receivables have also gone up, but what we want to know is the number of receivables that their customers owe them. Is the number remains flat or is it growing, right? What you don't want to do is if your receivable days go up, right? If you look at them, they've actually got 32, 35, 32, 39, 40, 41, 42, right? So they've actually been fairly consistent. That means as they grew, so here's where the clue is, right? They grew their business, right, from sheer competition without actually having to give even more credit. Now you have to understand this: a lot of companies grow because they decide to give credit. That is a very sort of kind of old trick in the book, right? You want to boost your sales, give credit, keep selling them, right? And that's kind of becomes your competitive advantage, right? And understand this: if one business can do it, every other business with a strong enough balance sheet should be able to do it as well, right? And if you have to compete on those terms, right, then it kind of gives you an idea that the business that you're in isn't very unique after all. And there is no strength in the core. Where's the value in the business now? In this case, there's a lot of value in what Nestle does, right? They were able to grow over time, and yet without giving extra credit terms. In fact, they've kept it quite stagnant, 30 to 40 days. That's been the average for receivable days, right? So fantastic working capital. So if you look at receivable days and you look at the receivable payables, right, this is kind of where you would want to see the strength of its liquidity. That is key, right? For me, less to do with the quick ratio, less to do with your current ratio, less to do with acid test ratio. I think these are two very good components to give you an idea how liquid the business is, right? Now, of course, you would also want to include what I call your operating cash flow as well. That's also very critical, right? Let me see if I can answer one question, right? So Ashwin is asking, what are your thoughts on projected PE earnings? Notice people are using projected PE these days to justify high valuations of some companies these days. Okay, so I'm going to answer this question when we get into the timing ratio segment, right? Now, so this was another one. Of course, this is a company that's actually gone bust and gone under. If you kind of look at what has happened, their receivable days have also gone up. Their payable days have also gone up, right? So if you look at how the stark contrast is from Nestle having a 0.3, 0.4 kind of receivables over payables, this is almost 10 times out of that. It's 3.3 or 4 times, right? So which means that the customers owe them a lot more than they owe their suppliers. Obviously, this cannot be a good sign, right? Why are they not receiving money from clients and yet their suppliers are not giving them extra credit terms, right? So you can see this number keeps going up: 2.13, 3.1, 4.6, 3.3. These still very high numbers. So you kind of start questioning, right? What is the receivables numbers looking like? And if you look at this here, this is their sales over their receivables. So you can see that it's 600 days, 300 days, 392 days, 447 days, 457. So that means 400 over days means that the customers owe them almost 1.5 years their sales, right? So the question is, are they now being the flip side of, giving so much credit that they have to give credit to actually stay competitive, right? And that's essentially what this is all about. So you want to talk about liquidity? I can tell you this company has very little liquidity, and that's why it folded in 2008, 2009 during the credit crunch or credit crisis. So you want to really have a good test of how liquid, whether your engine is well lubricated or not. Use these two numbers. They are very simple. They're very simple to analyze. They are also very business-like, because that's the whole idea behind it, right? How quickly can you receive money from your customers? How long do you owe your suppliers for? And that's essentially, these are the two ratios I would use to talk about liquidity, right? Now, on top of that, don't use only 1 year of liquidity. You want to use over a period of time. All right, so these are two ratios. Now, all these slides are available for download. So if you stay till the end, I'll give you guys the link where you can actually download this these slides, and you can kind of rewatch this if you don't understand, right? Now, let's talk about profitability ratios, right? Now, these are the three that I use. I use net profit margins, gross margins, and operating cash flow margins. I'll explain to you why. Okay, I'll explain to you why. So an illustration, where do I get this from? So this is your sales, this is your net profit, this is your gross margin, this is your net profit margin, this is your operating cash flow margin, right? I kind of explain each of them very differently. So again, I've kind of plugged them out to give you an idea really what they look like, right? So again, they kind of read from right to left again. So I put year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 10 being the 10 years ago, 1 being the latest year, okay? Now, so in this case, now, what is the first thing that you want to look at is actually your net profit margin. How much sales does your company do and how much profit does it generate from the sales, okay? Now, this number will give you an idea if there's something unique or special about your company that you're investing in, right? Now, in this case, having a 40-50% profit margin sustainable over the last 10 years, it's not easy. It's definitely something very, very unique, right? Of course, this company I'm talking about is Equitiestracker, right? Now, if you look at what they've done, right, they may not have fantastic growth on their revenue, but they've been able to maintain their net profit margin, which means they're doing something unique, right? Which means for every $1 that they do in sales, their net profit after everything is actually 50 cents. Now, this is incredibly high, okay? If you look at Apple net profit margins, is also considered very, very high for a $1 trillion company. They're looking at about 30+%, right? So to get a 48-50% is very, very significant, okay? Now, what happens that the second thing you want to kind of look at is what is gross margin? Now, gross margin is what does it cost for you directly to produce this product, all right? And versus how much you sell it for. So, for example, if I can create a product that is, I sell it for 1 ringgit, but it only costs me 10 cents direct cost, right? That equivalent gives me 90% gross margin. Now, that is exceptionally high, right? Now, when you have very high gross margins, it can either indicate you 2 things, right? Either it's a service business where the input is not, the actual cost of sales is not a lot, either a service business, right? Or it is you have an intellectual property or something unique to your product, and that's why you are able to charge your clients so much, right? Again, in this case, this is Equitiestracker, right? So you can see the gross margin is also very high. Typically, if you look at gross margins for manufacturing companies, you're probably looking at 20, maybe 30% at best gross margins, right? And then below gross margin is what you call your operating expenses, right? That's why you keep your business running. Now, to sort of parry the net profit margin with your gross margin, I also use this other thing called cash flow, right? Which means that if you're making 40-50% net profit margin, are you actually getting it in cash itself, right? And this is another way of really looking at the liquidity of the business as well. So I kind of use all these 3 to give you an idea on how profitable the business is. You realize I don't use ROE because it tells me very little about the business, right? Having ROE, right? So of course, ROE could also be for different types of business which are very asset light. Your ROE looks very, very high, but doesn't mean it's a good thing, okay? So that's just to give you an idea how I would manage or look at profitability, right? Okay. So I have another company just to give you a contrast, right? So I'm going to give you 2 contrasts, right? This is a company called Guangchong Berhad. They deal in cocoa or commodity trading. Now, if you can kind of have a look, right, you can see how big of a difference is, right? So if you look at Equitiestracker earlier, they had 100 million in sales. They make about 75 million net profit. Huge, right? 50%. On the other hand here, this company here, Guangchong, actually, if you can read my numbers here, they make about 2.9 billion in sales. It's very big, right? Numbers bigger, right? But the actual net margin is only 7%. Now, when you have very thin single-digit margin companies, what it tells you is that what you're dealing with is very commoditized. And where the risks are here, very simple. If your costs go up, say 20-30%, you could be writing down a loss. right? Or for any reason for your cost. Could be foreign exchange, which is completely out of your control. It could be increase in labor costs. It could be increase in commodity costs. A lot of them may not be actually in your control. So remember, when you're investing in a business with very low single digit margins, there's actually not a lot of wiggle room for them to make mistakes, right? So it has to be very, very tightly run. Not to say it's a bad thing, but they have to be absolutely very, 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 very tightly run. So if you look at this company, you can kind of have a feel of why small changes will actually make big changes, no matter you make profit or not. So in this case here, you're looking at 9% become 0%, become -1, become 1%, 2%, 4%, 8%, 7%, right? So really, that's the whole idea of having single digit margin. Now, essentially, what do I like? I prefer to have companies where they are in double digit margins, right? Which means that they are able to make a decent amount of margins, because that will give me a clue whether they're a good business model to invest in or not. All right. Similarly, gross margin is the same. So you can see the gross margin is also very, very low, right? 9%, 15%, 4%, 7%, right? So you can kind of see, because they are essentially a trading company, their gross margins are meant to be very, very low, right? Essentially the whole net profit margin will be low, right? Now, if you look at this company here, even though it's got 7% net profit margin, it actually did not receive any operating cash flow for that year, or be negative in that sense, right? So you can kind of see that it fluctuates up and down, up and down. So if I kind of use this as an example, I'm not saying it's good or bad, right? But it is what it is. You have to accept, because these financial ratios will tell you exactly what the business does, right? So when you kind of look at this, the question to yourself is more personal in nature. Would you invest in a company with high margins or very low margins, right? And that's to give you an idea on profitability. So you need all four, right? Of course, this is the share price, right? Now let's talk about gearing. Now gearing, I do, the whole idea here is, let's not overcomplicate things. Let's keep it as simple as possible. One of the things that I want to know about gearing is very simple, right? For those of you who are not familiar with the word gearing, it means how much debt are you in, right? Are you in a lot of debt? Are you in very, very little debt? Okay, now what is the fear here? When you're in a lot of debt, and say something like COVID-19 happens, right? How are you going to sustain your business in absence of cash flow, which is absolutely not in your control, right? You got to think about it. So if you're a lot in debt, and you think about it, you have a lot of debt, and you are depending on your business to maintain that cash flow, and one day if that cash flow shuts off for whatever reason, how are you going to service and maintain that business? I think that is very, very, very important, and that's really why we're looking at that. So there's a big difference. So if you're in COVID-19 and say you had 2 years of cash and you had no debt, it's actually not going to stress you out. Business will still run as usual, right? But if you had a lot of debt and you had serviced the debt, and suddenly your cash flow dried up and you had very little cash, how are you going to sustain your operations, right? And that's essentially what gearing tries to measure, right? I'm here trying to measure the risk, right? So I have a question here from Lionel Lim. He said gross margin, gross profit margin, and is industry dependent. Absolutely right. You're right. It's not only industry dependent, it is business dependent. All right. If you're a trading business, or you are a manufacturing business, or you are a service business, those will all depend on your margins, right? And the best thing about margins is very simple. You look at the company itself, and then you look at its competitors, right? Or close as possible to give you an idea whether the business is high risk or low risk, right? You're right. So example, where I showed you two very distinct differences between Yuchitech and Guan Chong, they're in very different businesses, and because they are in the trading business, margins are low, right? Not to say it's a good or a bad thing. It just simply means that that's the nature of business, and it's very personal to you whether you invest in a higher margin business or you want to invest in, invest in a lower margin business, and that's absolutely fine. It's really up to you, right? And I guess kind of the trend of why a lot of these tech stocks are doing so well today is because they've created this mode or a platform where it's so difficult to break, right? And that's really where they're getting those margins from. And that's kind of gives you a clue, right? How valuable the business actually is to give you an idea. What they call it, economic mode, right? So the higher the margin, the higher the economic mode, right? To give you some example, I mean, you look at Amazon. Amazon is literally, taking the whole US by itself, right? From its cloud system, cloud operating systems, to its Amazon.com where they buy and sell stuff. And they've got such a huge moat, right? That who would, it's going to be very difficult to come out and compete with them, right? Same thing if you look at Apple, right? Why do people pay super premium prices for Apple? Because they have that X factor or whatever factor it is, right? That gives them that extra high margins, right? And those kind of factors are very difficult to create, and that's why they become very valuable, right? So just to give you an idea, for that, but it was a good question, Thanks for that question, Lionel. So it's a very personal thing. Now, so we talk about gearing now. Gearing is the next one. Look, gearing is it's gonna sit you right in the middle. It's either you're gonna be very efficient with your cash, or you're gonna be very safe. There's no in between, unfortunately, with gearing, right? You can't say, no, I want to be very efficient with my cash flow and my capital structure, and at the same time I want to be very safe, right? Unfortunately, these two don't exist in the same kind of time frame, right? So example, I'll give you again two very distinct examples, right? So one of the things that I do measure is how much cash the company has over its total debt. Okay. So if you look at this, this is the case of Equitiestracker, right? They've got a lot of cash and they have almost no debt. So they would, what I call, very safe, but I would say very inefficient with the cash. Right. So again, like you say, there's no in between, right? The other way I measure how sorry, this shouldn't be profitability ratios, this should be gearing ratios, right? So I'm going to change the slides, but this should be gearing ratios here. The other way I want to measure gearing is your ability to repay. Okay, so how do I know the ability to repay? All I do is I take my operating cash flow over my total debt, right? So in this case, from a cash perspective, they are what I call a net cash position company. From an operating cash flow basis, they could, a couple of days of cash flow, they can pay off all the debt if they wanted to, right? So this company is essentially a debt-free, or it's got no gearing at all. No gearing, right? So again, very safe, maybe not so efficient. Okay. Now this is Nestle. Now this is Nestle. I want to show you why you need to look at two distinct portions, right? Nestle is very, very efficient, right? If you guys can see from the payables and receivables, they can collect money very fast, and their suppliers give them long credit terms. Now, because of that, that's actually translated into extra cash flow for them. Now, so let's look at Nestle, for example. This is the cash that Nestle actually has over this period, and this is how much debt they have now. So if you look at this, they are definitely not in a net cash position, and you probably look at this and oh, should I be worried, right? They have so little cash, and they have 10 million in cash, they have 600 million in debt, right? Is that scary or not? Okay. Now, so when you look at the other prism, where I'm going to tell you that it's not so scary, it's actually in fact quite safe, is this. If you look at their cash flow here, their cash flow is 500, 800 million, 900 million, 700 million, 700 million here, right? That's their cash flow every single year. Now, if you look at it over their total debt, if you just even look at the latest year, whatever cash flow they can bring in 1 year, they can actually clear off all the debt plus more. All right. So in this case, they got 700 million in cash flow. They got 600 million debt. So imagine this. I want you guys just to imagine, to give you some context, right? For those of you who have a mortgage or a home loan or whatever it is, right? Think of this, right? So you take a home loan, let's say 30 years or 35 years, right? But let's say your income level in 1 year, you can pay off all your home loans. Everything settled, right? Are you in debt? Yes, you are in debt, right? But your ability to repay is very, very, very high, right? So in this case, I would still classify them as fairly low risk. Now, the question here is, you have to look at the nature of business, but because Nestle's business is really kind of at what we call basic needs, right? That cash flow for the foreseeable future will continue growing, right? Or will continue to flow, right? So they can still sustain their business using this model. So I'm going to show you another one for gearing. This is Sapura Energy. They used to be called Sapura Kencana actually. They've changed their name. But if you look at this is the cash that they had, 2 billion, 1 billion. It's kind of dwindled about 700 million cash that they have. But their debts have actually grown to about 10 billion, right? It actually dropped significantly from this year here because they used the cash to settle the debt because they raised more money. But if you look at this, 700 million versus 10 million, so they've got about 7%. So no way would you say their net cash position. Now on top of that, because their business is they're in the oil and gas industry, right? So you're going to get boom and bust cycles. Now if you look at their cash flow versus their total debt, it's also about 7%. That is not a lot, right? Just to give you an idea, right? So if your interest rate is say 5%, that leaves you actually very little room, right? To cover any of the expenses. Now the whole idea here is this, right? Assuming there is a event which is out of your control that actually affects the business, are they able to repay their loans, right? If not, they're going to be classified as PN17 under Bursa rules, right? And that's really kind of how you analyze that risk portion, right? So we've gone profitability, we've actually looked at liquidity, and the third one here is actually looking at the leverage debt ratios, right? So how I hope I'm explaining it in a very simple way that you guys must look at it from a business standpoint. The question is, if there's some event that's happened, can I sustain my business? That's the whole question, right? And how much debt I have means, can I service my debt if there is no cash flow, right? So just to kind of give you a clue that when you look at ratios from a business standpoint, they're going to tell you a much better story than kind of copy and pasting some of the ratios out there, which is very common, right? And that's really the whole idea here is to be able to assess your risk. Look, the last one that I'm going to talk about is essentially your timing ratios, right? Your timing ratios, I'm going to talk about three, right? First one is your PE, the dividend yield, and your price to book, okay? I don't typically use price to book, right? For anything except maybe for financial companies, right? But price PE ratios and dividend yields are a good indicator for timing. Okay, it's a good indicator. Now remember, I said anything to do with price, you have to use price to compute your numbers, means it's timing, right? Now, so in this case, how do I actually calculate a PE ratio, right? Your PE ratio is actually your earnings per share, or your price over your earnings per share. And what is earnings per share? Is total profit divided by the total number of shares, right? So in this case, PE ratio is price over earnings per share, and that's it, right? And dividend yield is the same. It's dividends per share over price. So they're kind of almost the same, but that's really the formula. Again, I'm not going to spend time to go through the formulas. You guys can actually Google them, but I just want to look at it, show you guys from a aspect of how do you actually use some of this, right? Now, one of the very important things that you have to understand whenever you're computing PE ratios or dividend yields, you have to understand this. Very, very key that any of the because you're going to use price is going to be one component. There's going to be another component. So for example, EPS, right, it will be earnings per share. If it's dividends, it will be dividends per share, right? So that component that you're using, don't forget you're looking at price. Let's say if stock price is 1 ringgit, you must work out the earnings per share. Now, how you're actually going to work it out is based on the total number of shares they have. Now, understand, because this is very important, because otherwise you're going to get completely wrong numbers, okay? So you must look at the number of shares in totality, and that's very important. So I kind of I have some time to kind of put it all together, but to give you guys an idea, right? So today, it's August 2020, right? If you look at, everyone's saying that the market has gone up significantly. I don't believe the whole market has gone up significantly. In fact, half of the stocks today, the last I checked, are actually still mid to below their 52-week high, which means they are cheaper today than they were a year ago, right? Now, and I kind of put banks here, and I kind of wanted to give you guys an idea what they look like. So what I did was I put 9 listed banks that we have here. So Maybank, Public Bank, CIMB, Hong Leong Bank, RHB, M Bank, Bank Islam, Alliance Bank, and also Affin, right? Now, what I did was I actually ranked them by market cap. That means how big they are, right? So, of course, Maybank is, in terms of size or in terms of pricing, they are the biggest. They are 84 billion in market cap. Next is Public Bank. Now, market cap is pretty much just price multiplied by the total number of shares, right? So this is just by price, biggest by price, okay? So Maybank, Public Bank, CIMB, Hong Leong Bank, RHB, M Bank, and so on and so forth, right? So the largest bank is 84 billion, the smallest bank is 3 billion, okay? Now, one of the things that you kind of want to now use PE and DY is very simple, right? You want to use, now, we all know that banks are kind of down today, right? Because we are in a technical recession, right? Of course, in recessions, people may not pay up loans and so on and so forth, right? So banks will definitely be affected, right? However, right, the question here is, if we're looking forward and investing, right? If we're looking past 2020, 2021, 2022, right? As we know, generally in all recessions, the next after a recession is going to be a bull run, right? Or no, I mean it's gonna be a boom and bust cycle. So we're in a recession, and then likely we're gonna see growth again. And generally, when you look at this kind of bull runs, and if the banks survive and they do well, right? Banks are a very essential part of the economy, right? And what's the beauty of this is, in all recessions, or in the last two recessions, right? What governments have resorted to is what you call pump priming or quantitative easing, printing a lot of money, right? And the whole idea about printing of money is that it increases the quantity of cash or liquidity in the economy, right? And actually, one of the most direct beneficiaries of printing of money is essentially are the banks, because they only make a factor of what is created out there. So as long as things are relatively stable and there is growth, right? Banks will really capture the difference between how much quantity of cash is out there, essentially. And if I want to put all these numbers together to get an idea, right? This is how I will do it. I'll use some ratios, right? And in this case, I'm using PE and dividend yield, and I'm also using price to book, right? And what I would do is kind of rank them all together. Say, look, they're all banks, right? Now, there is differences between each bank, okay? I do highlight. Now, it's very different from the US, right? US, you have JP Morgan, Goldman Sachs, Bank of America, right? But we have to differentiate, those are investment banks versus normal commercial banks, right? So the ones in Malaysia here are still very much commercial banks, right? And if you look at them, if you rank them by dividend yield, you can as well. So I've ranked it here by size, right? But if you rank them by dividend yield, for example, right? Maybank say 8.4%. I think the highest you're getting is M Bank, right? 8.6%, and then CIMB at 7.5%. Now we have to understand these dividend yields are historical in nature, right? The question is, are we if banks pay dividends this year, are they likely going to be lower? Absolutely, right? If they're going to be lower profits, or even any profits at all, they're definitely going to be lower. So this is where the projected numbers come in, right? I think Ashwin was asking me earlier, what do I think about projected? I think we have to use projected now, because if you're using 2020 numbers, right, financial numbers, to give you an idea, I'm going to tell you, you're going to be very disappointed. So in this year, if you're going to use any kind of financial ratios, they're not going to tell you anything normal, right? Because something normal didn't happen. Businesses were shut down for 2 months, 3 months, right? So you're even though our calendar year is 2020, we're not actually seeing what numbers would be if they were normal, right? Normal numbers were going to start coming in next year onwards, 2021, 2022, right? Those were normal numbers. So we have to use some kind of basis to project, right? So we say, look, if everything goes back to normal, say 2022, right? 2 years from now, and the economy stabilizes, we're on a good growth rate, interest rates start moving up slowly, right? Which is the whole idea here. Then if these banks can kind of normalize and make back profits that they made, say, the year before, right? If they can make back what they made in 2019, then essentially today you will be buying them at 8% dividend yield, okay? Or 4% or 7% or whatever percentage it is, right? Now, also the same thing for PE, right? So you're going to use the current price versus whatever last year's earnings. So these are essentially, if I want to use these numbers, and that's where the context is important, I should be using 2021, 2022, and that's where I'm using that projection. So my assumption is this: banks by 2022 should earn at least, or if not more, than the same amount they did in 2019. Okay, that's my assumption. In 2022, when banks normalize, they should earn the same or if not more profits than they did in 2019. Okay, so that's like a 3-year gap, right? So if you're looking forward there, then essentially if they pay the exact same profits, they pay the exact same dividends and they make the same amount of profits, then these are the yields that you are buying them at today. These are all timing yields. Okay. Okay, so Gerald, you asked a good question here. Are these dividend yield and P ratios using 4Q numbers? No, they're not. I'm actually using the last year financial numbers. Okay. The reason why I didn't do that is because this year you're gonna get extremely high PE. For the reasons what I've just explained, right? You're gonna get an abnormally high PE. You're gonna get an abnormally low dividend yield, right? I'm using last 2019 as a projection for say 2022, right? And that's the reason why I've kept them here. Now, based on today, now of course, bearing any write-offs, right? These are all their price to book ratios, existing ones, right? So you can see whether it's a premium or a discount, right? Like for example, CIMB is selling at 40% discount to their book value, right? That's based on last year, right? Based on current price, they're selling at 40%. RHB is selling at 25% discount. MBank is 51%, right? Generally, actually, historically, public bank has always commanded a much higher premium over their book value historically. Now, how I did this? I did a 10-year average of all the price to book ratios. 10-year average based on the end of year prices was just the average only, right? And you can see public bank is always traded at a 2.65, on average 10 years over its book value, right? Today you're trading at a 54% premium, right? Generally, Maybank has been trading at about 1.6 times, right? Its book value. Today is trading at a 4% premium, right? So you kind of see, so RHB actually trades only at about 11% premium to their book value. Right now it's at a 25% discount, right? So generally, what if you look at it generally as a sector, you're gonna see that most of them are trading below their 10-year average premiums, right? Where they are today, right? And I kind of want to sort of close this off with this was I want to give you a practical approach to use financial ratios, not just one by one, but kind of collate them together, put some thought into it, and kind of build those projection models that you guys want to build, right? And this segment is very much for the financial ratio geeks, right? All you guys financial ratio geeks who are very used to these financial ratios. I just want to share you, these are some things that I do myself. Okay. I'm happy to answer any questions if you guys have. It's almost been 1.5 hours. It's been quite a long segment. Thank you very much for staying all the way. So if there are any questions, I'm happy to answer them. I've got one here from CH Ang. What makes Equitiestracker so unique? They're unique because they actually are an ODM, original device manufacturer, not ODM, right? So which means that they actually create the product, and they have exclusive. They only give or they have a partnership where it's exclusively only sold to one person, right? So they only sell that one product to that one person, and the one person only buys directly from them, right? And that's why they can charge those margins. So which means that they do all the R&D work and everything, and do the whole manufacturing, and then the marketing is passed on to another party to do that. So it's a symbiotic relationship that they've had over close to more than 20 years, right? That's why they are able to get a 50% margin for what they do, right? Yeah, so if there are any questions, I'm happy to answer them. If not, thank you very much, all of you guys. Oh yes, before we kind of end, there is a link for you to download today's slides, right? If you go to the link here, right? 2008-22 Bursa slides. You can actually download exactly what you guys have seen here. But you have to complete an evaluation form, right? So which means that this segment is brought to you by Bursa Malaysia. So they would like to get your feedback. If you dislike me, dislike the content, or you like the content, I'll very much appreciate it if you guys can click on the link in the comment below. My colleagues have just posted it up to give me feedback whether you liked it. This is our final English segment, right? For Saturdays, right? So okay, so let me kind of answer some of those questions here. Let me answer some of the questions here. Okay. So let me go one by one. Okay. If we have an investment time horizon more than 2 years, would it make sense to consider bank stocks as current? So Jason, unfortunately I cannot provide you financial advice because I'm not licensed to give financial advice. But that would be something that you have to take out with a financial advisor. You have to do your own research and homework, measure your risk assessment to decide whether you would want to look at banks. Okay. Wellcall has fairly high margins as well. They are not really an ODM or kind of ODM. They are kind of ODM. Wellcall actually makes rubber hoses for a lot of the European brands as well. So they got very nice margins as well, 20-30% net margins. Yeah, kind of similar like Equitiestracker. Okay. Okay, don't forget to click the link to download the slides and give us feedback. Okay, what is my view on high PE of growth companies? Well, that is, let's do my view. I guess the whole idea here is this: when you are trading at 100 PE, right? The question is, are some of these numbers or these COVID-19 numbers, are they sustainable going forward for the next 20-30 years? That's the question that you need to answer when you talk about PE ratios. Okay, Daniel Dunn, I've shared in a comment. Click to give us feedback. I would appreciate it very much. Okay, what is book value? How significant is it to judge a company's financial strength? Look, except for banks, I will look at book value. Generally, I won't use book value to use as a guiding point. The reason why we use it for banks is very simple, because they are in the cash business. Whatever products they're selling is cash. They're in the service business, right? But for other companies that's manufacturing or service based, to me, generally, book value does not have a lot of meaning. You have to really look at that balance sheet to figure out what kind of quality of assets they have. Just by the number, you're not going to get much from it, unfortunately. All right. Thanks for that question, Anthony. Enterprise value. Yes, that's one of the valuation techniques I do use. I like it because it's very simple to do. One of the things that I use a modified version of enterprise value where I call business PE, right? And that's something that I cover in some of my advanced classes. But that if you notice, most of the things that I do are simple. It has to be business-like, and that's the whole idea, right? But also, just using one ratio, again, I must warn you that it may not give you the full picture. Okay. If all world economic powers going for negative interest rates, will bank recover by 2020? Interest rates, ironically, actually does not affect banks. As much as we kind of think, it doesn't affect it positively, nor does it affect them negatively, because they earn the spread. So I'm talking about commercial banking, right? So from this case, probably not. Yeah. Okay. Okay. Thanks for all the comments. Okay, thank you. Thank you for tuning in on a Saturday. I do appreciate your time. What guidelines for selecting Malaysian REITs? Actually, I did have a segment on REITs, so you guys can check it out in one of the videos. You search for it either in your YouTube channel or on our Facebook page. Actually, I did one a segment on REITs here. I think it's episode 1 or episode 2, right? So you have to kind of go back 7 to 8 weeks, and you're gonna get that, Kenneth, right? Look, I think we're kind of time's up, right? So you're gonna see. We'll be back tomorrow night at 8 p.m. For Ask Us Anything. Do ask us, right? Again, very, very sincere thank you to Bursa Malaysia for bringing this event to all of you guys here tonight, and thank you very much for all the questions that that has come through. If you can do me that favor to click on the link and give us feedback, I would be very much appreciated. Otherwise, thank you very much for tuning in. It's always great to see you guys online, and great to see you guys. Looking forward to learning, right? Thank you again, Bursa Malaysia, and of course, you guys for joining in. Good night and bye-bye.